Hello, this is Team 2 with the finance class. This is going to be an analysis of Smile Direct Club. This analysis was done by Neely Pike, Garrett Whitfield, Zeri Beatty, Thomas Porter, and Louise Williams. So Smile Direct Club was established in 2014 in Nashville. It's an international oral care provider. The company was established on the premise that premium affordable healthcare should be widely available and easy for consumers to access. Smile Direct Club operates hundreds of its own brick and mortar locations and is partnered with over 1,000 dentists. The club operates its own customer service platform, which provides its customers a unique 24/7 access to telehealth dental teams. Setting their teeth alignment strategy even further apart from traditional braces is that members can achieve straight teeth within 6 months. The club provides members with the opportunity for straighter, brighter, and cleaner teeth at the convenience of time and money. It's ultimately a low-cost tooth alignment solution that works as a substitute for braces. So problems and solutions. The problem they're trying to solve is that orthodontics is too expensive and inconvenient. The majority of Americans are, more than 80% of them could benefit from orthodontic care, yet only 1% of them actually reach it or receive it for that matter. The gap in people that are not able to receive orthodontic care opens a tremendous customer segment that's basically providing Smile Direct Club with many different revenue streams. They differentiate themselves from classic orthodontics first with cost. Their teeth alignments are up to 60% less than traditional braces, so they are putting the total cost at 40% of the cost of regular braces. A secondary benefit is convenience. After a member's single visit to a brick and mortar Smile shop, they can receive their first set of clear teeth aligners sent to them in the mail. And then after that, Smile Direct Club members can create their own forms at home with forms provided from Smile Direct Club, and then they can receive even more updated teeth aligners for when their teeth go from crooked to more and more in line. Virtually all of it can be done at home. The industry overview and competitive positioning, as well as the investment summary, these are slides done by Zeri. She's having COVID-19 issues.
Good evening, this is Louis Williams. I'll be covering liquidity, the profitability, and the turnover ratio. So a few things that you'll uncover in the financials once you get into the meat and the potatoes of Smile Direct are, one, the liquidity. So why is a company being liquid important? It's because it's going to help address some of the short-term issues as far as debt goes. So I'd like to point out on this specific slide, the current ratio. Back in 2017, Smile Direct had about 0.67 the amount of current assets as it did as far as the liabilities. Although some would say this is like fairly low, it is really approaching the threshold for being, whether it's decided on being good or bad. You'll notice the trend of it going up around 2018, but then right before the pandemic, you notice a downturn. This can be something that startles people from purchasing the stock. But then as you get into the pandemic, you also notice another drop, and that for sure will be something that will be something noteworthy to take a look at as you go deeper. Can I get the next slide? All right, now I'd like to discuss the profitability ratio. The margins that Smile Direct has had throughout its entire life once it went public have been negative. The reason why this is important is because the reason you're in business is to make a profit. And if you're profiting, the people who invest in it, which is why the return on investment is significant on this slide as well. The people investing in it know that what they're putting in their company, they'll be able to get out. Now, although you saw a slight increase going into 2020, and we're predicting a somewhat getting close to a positive trend, so to speak, it's no guarantees, and it still draws a lot of concern, because how long can they depend on other things as far as going into more debt to bail them out of the debt they're currently in? So this draws a lot of concern for future investors and people who desire to get into the company. Next slide. The final slide I'll be covering is the turnover ratio. This is another slide that will cause people to raise their eyes at the stock. This is why I personally would say we definitely needed to choose to sell it. We're predicting that Smile Direct's inventory is going to get even more stagnant going into 2021. Given the pandemic and how things are going, I honestly can honestly feel safe about saying that people are going to place getting the services that Smile Direct provides on the back burner as far as like trying to get forward. Now, looking at the long term, you will notice if you look through the financials that they have a poor life cycle with performing with their product line. It takes a little bit over 100 some days before they cycle out an asset to actually get back profit. This is also a concerning factor when it comes to should you buy or sell any product for that matter, or any stock for that matter. And finally, I'd like to take notice of the value in the conversion cycle. Smile Direct could have some issues paying off the debts that they have if they're not turning over the products, or they're not turning the assets into product that's being sold. If they're not profiting, this can become something that puts the product or the business at threat.
Hi, this is Neely Pike. I was in charge of conducting the valuation for Small Direct Club. So in order to do this, our group chose to conduct the valuation by using a DCF model. We also completed this type of model for Align Technology, which is Small Direct Club's biggest competitor, and just for industry comparison. We decided to carry out this type of evaluation. It would be best to use a two-stage free cash flow to equity model. To determine this, we first had to determine the discount rates. For these, we used the risk-free rate, the equity risk premium, and we decided to multiply all of these together to determine the discount rate for the firm. So we were able to do the risk-free rate plus the multiplication of the levered beta times the equity risk premium. This gives us the discount rate for both Smile Direct Club and Align Technology. Next, for the stage 2 of our free cash flow to equity model, we took the current discounted rate, which for Small Direct Club was 6.82%, and multiplying it to estimate the cash flows for the next 10 years. We multiplied the discount rate by the estimated cash flow, which determined the present discount value for the next 10 years. To reach the estimated amounts for the cash flows for the years 2025 to 2030, we discounted the revenue growth percentage as an estimate of how the company would grow over the next 5 to 10 years. Next, we determined the present value for the firm over the next 10 years, which for Small Direct Club was $964 million, and for Align it was $5,288 million. To complete this, we added all of the present discounted values together, which led us to these numbers. Next slide. For stage 2 of our FCF to equity model, we wanted to prove our stance to currently sell the Small Direct shares by proving that it doesn't adequately compare to competition or industry ratios. To prove this, we determined the firm's present value to terminal value, which was calculated by taking the terminal value and dividing it by 1 plus the perpetual growth rate to the 10th power. Then we determined the total equity value, which led us to determine the total equity value per share. This led us to the decision that SDC was actually underpriced. Therefore, to many investors, that would be very enticing, but as compared to other people within the industry, as well as other risk factors, this has led us to determine that it's too much risk as of right now with all of the other problems that the company is coming into to determine a sell value. So as we see, the current discount value for each firm, SDC actually has a negative value, or has a positive value, which as compared to the fair value is actually underpriced, where a negative value considers a firm to be overpriced. Therefore, according to industry and size of the company, this is where we get a fair price, which would mean that Smile Direct is therefore underpriced. Next slide. Next, we decided to complete a PE ratio and a book or price to book ratio, which further determines why we want to sell as opposed to buy Smile Direct Club as compared to their main competition and industry, as well as US market ratios. The PE ratio is negative, which goes into the amount of income and revenue that the company has had over the past couple of years that it has been public, as compared to the medical equipment industry ratio and the Align ratio, which are highly, highly positive. Next slide, please. The PEG ratio is where things kind of get interesting for Smile Direct, because it again is negative because of the past income ratios and everything like that. Therefore, based on the perpetual growth and the net income rate growth of the future, people are seeing that Smile Direct has a high prediction to grow. Yet with their negative PE ratio, you multiply those together and you get a negative ratio overall, as opposed to a higher ratio industry wide. But the more negative a ratio is, the more attractive it is to an investor. Same with the price to sales ratio. SDC has a very, very low or very high price to sales ratio, which is less attractive to investors. The smaller the number is, the more attractive it is to investors.
This is Garrett Whitfield. I have investment risks and corporate governance of Smile Direct Club for this analysis. So, investment risks include that Smile Direct Club has had a history of net losses, and they reported in their 10K that they might struggle to maintain or achieve profitability for their company. From December 2017 to December of 2019, they have incurred net losses of $537.8 million, including $240 million of non-cash compensation expenses. This is somewhat understandable, being that they are a newer company. So getting into the market, in this market, which is very competitive, can be hard, but those are also numbers that need to stand out. Smile Direct Club is only one main operating segment, which is their aligners. They depend on these sales of these aligners for the majority of their net revenue, which can kind of signal a red flag that a company only relies on one main manufacturing subject for their company. Smile Direct Club also relies on third-party suppliers for some of their manufacturing. Having a third party can involve costs that are unexpected in the future. Smile Direct Club stated that this could cause potential inability to obtain or produce quality products in a timely fashion, which consistency is needed in a new company in a market such as the market that Smile Direct Club is in. Because of COVID, obviously, there have been some complications. Smile Direct Club attempted to produce aligners internally, so they cut out the manufacturer. This move was meant to cut costs. However, gross margins decreased 7%, in the last 7 to 8 months. Smile Direct Club is also a controlled company, which this was stated in their 10K, a controlled company within the meaning of the corporate governance standards of NASDAQ. As a result, they qualify for and rely on exemptions from certain corporate governance standards. The corporate governance of Smile Direct Club includes a board of David Katzman, Stephen Katzman, Alexander Finkel, Jordan Katzman, Susan Greenspoon Remelt, Rick Schnall, Senator William H. Frist, MD, Carol J. Hamilton, and Richard F. Wallman. The independent directors are 5 of the 8 that were listed above, and each of them have a subpar record of capital allocation. Using Morningstar, the data shows growing revenues for the past 2 to 3 years, despite small returns. The ROE, or return on equity, and ROA, return on assets, percentages are all negative. Many former employees report the SDC is a good company. However, their management practices reflect the most concern for profit generation. After reviewing the board of directors, SDC's board is so profound in their business that entrenchment is of great concern. And entrenchment is a situation where managers use their position to act in ways that only benefit themselves and not that of the shareholders, which is also another red flag for the future and for people that want to invest in Smile Direct Club. Since corporate governance continued, this is a comparison to one of their main competitors, which is Invisalign. Their corporate governance is more focused on the quality of the product, and they are more cognitive of the size of their board, and that's Invisalign. SDC has a large board of directors compared to Invisalign, which that kind of brings in the entrenchment part of it as well, and also more chances of a takeover within Smile Direct Club. And also, this is a very interesting detail that I found in the 10K. It states that the chairman and CEO, because of our current chairman and chief executive officer has other business interests, he may not be able or willing to devote a sufficient amount of time to our business operations, which could negatively impact our business, results of operations, and financial condition. This is very important to note how the management side of a company can appear to be focused and driven, but if a CEO has other business interests that could hurt the company, then this company could be more at risk to failure. So with a newer company having getting a startup in a market like this, having a CEO that isn't exactly focused on the company's success, that could definitely be a red flag for investing in a company like this for future gains.
This is Thomas Porter with the conclusion. Based on Neely's valuation, Smile Direct Club is a very undervalued company. It has great opportunity for growth, and the revenues have been increasing steadily. They recently also drastically decreased their greatest expense, which was marketing expenses. They got their feet planted and everyone knows their name, and now they've cut that expense. So they're learning from their liabilities. Some of their greatest risks, however, is it's an unproven business strategy. They're operating with a single-use customer base. So once the consumer gets straighter teeth and are satisfied with that, they will not be using Smile Direct Club services anymore. So each customer, that is their first and last time using Smile Direct Club. The other risk is the orthodontics company. Despite its great revenue growth, right now is not a good time for unprofitable IPOs, especially in a market such as orthodontics that has an increasing number of competitors. Some of the new competitors are 3M is coming out with its Clarity aligners. You've got Invisalign, which IPO'd years ago. And also just standard braces. Based on the risks of such an unproven business strategy, the growing amount of competitors, and its unconventional board of directors, our final recommendation is sell and not to buy Smile Direct Club.